On April 1st, we saw the latest read of U.S. ISM data, and it was not viewed as particularly equity-friendly. Now, the manufacturing component of the number was higher than expected, as was the prices paid component, leading many to believe that inflation may be reaccelerating. Now, the inflation story has now pushed the probability of an ease at the next Fed meeting from 25% on March 1st to less than a 5% probability on April 1st, according to the CME FedWatch tool. The market is also now pricing in only 67 basis points of easing by the end of 2024, and that's down from 170 basis points at its peak back in January. Now, for the last 3 months, equity markets have been able to rally despite rising interest rates, but now things may have changed. U.S. two-year yields have traded up to 4.74%, equaling a high made in late February and then again in mid-March. The arrival at these levels has seemed to send some fear into equity traders who feel the risk is that the two-year takes out those previous highs and causes a short covering rally in yields. Now, there are two key data points approaching that have the potential to push markets: the NFP data on April 5th and then the CPI number on April 10th. If these numbers come out in uncomfortably high areas, it could push yields higher and cause a ripple effect in rate-sensitive assets, like stocks. Now, if a trader believes the S&P 500 could fall from here, they could express that by selling the June micro E-mini S&P 500 contract at 52.46 and target a move to the mid-February lows of 5,000. Now, stop for this trade to be placed above at 53.70. This trade can make $1,230 if the target is reached and risk $620 if you're stopped at your level. Now, if a trader believes the S&P could rally from here, they could express that by buying the June micro E-mini S&P 500 contract at 52.46 and targeting new highs of 5,400 on the upside, with a stop placed below at 51.46. Now, this trade can make $770 if the target is reached and risks $500 if you're stopped out of your level.